Okay, so because of modified internal rate of return and okay, so let's solve this illustration number 4. Yeah, illustration number 10 rather. Okay, so I need somebody to read for us. Who will help us to read? Yep. Who will help us to read the question? Telemundo PLC, a company listed on the Nigeria Stock Exchange, is involved in property development and sales. The company currently imports more than 60% of its cement requirements. At a recent meeting of the board of directors, decision was taken to establish a division for the production of cement in our Ondo State. If the division is set up and the cement production goes ahead, output from the division will be sold to Telemundo PLC and external customers at a market price. For planning purposes, it has been decided that the financial viability of the project over the next 5 years should be determined. Okay? The sum of 2 billion naira will be required. The sum of 500 million will be spent to acquire an existing factory considered suitable for the project. The balance of 1.5 billion will be applied for the procurement and installation of essential plant and equipment. Tax allowance can be claimed on plant and equipment on the uniform amount over 5 years with no scrap value. Okay. A total of 20 million naira has been spent on various surveys, including markets, technical, financial. To date, out of which 10 million naira has been paid. The balance of 10 million naira is due for payments at the end of year 1. Production of cement for the next 5 years is projected as follows. A bag of cement sells currently for 2,000 naira in the open markets. This price is expected to increase at the rate of 5% per annum. Variable cost is now 800 naira per bag. This will increase at 4% per annum. Fixed overhead cost will be 50 million naira at current prices, but will rise by 8% per annum. Apportioned head charges of 25 million naira at the current price will rise by 10% per annum. 50% of the total initial outlay of 2 billion naira is to be funded with a loan from a federal government development bank at a concessional fixed interest rate of 8%, payable at the end of year 5. The project will require a working capital of 10% of annual revenue, and this should be available at the beginning of each year. The company uses a current weighted average cost of capital of 11% to appraise all capital growth projects. The asset beta of the company is 1.2, equity beta is 1.6, risk-free rate of return is 5%, while the market risk premium is 7%. The finance director is of the view that it is not appropriate to use the existing work to appraise the new project. He has identified a listed company currently produces cement and packaged fruit drinks. Okay. The company has the following financial statistics. 60% of The market value of the company is attributed to cement production, while 40% of the value is attributed to the fruit drinks division. The fruit drinks division has equity beta of 0.8. The new project is expected to move Telemundo PLC to the target debt equity ratio of 30%. Tax rate is 25% for the two companies and is paid in the year profit is made. You are required to compute the appropriate cost of capital that Telemundo PLC should use to appraise the cement project and state why you consider this rate more appropriate than the existing WACC of 11%. Note, your final cost of capital should be rounded up to the nearest whole number. State any assumption made. B, compute the net present value and the modified internal rate of return of the project, assuming a cost of capital of 13%. Work to the nearest million. Recommend whether the project should be accepted or not, using both NPV and modified internal rate of return. All right, so that is the question. That is the question. This is a very straightforward question. In the number A, you have to calculate appropriate cost of capital. Therefore, you need to ask yourself, what kind of cost of capital am I going to calculate? Is it traditional weighted average cost of capital? Is it project-specific cost of capital? Or is it weighted average cost of capital of combined activity, WACOCA? So you need to determine that. When you go to the first paragraph of this question, examiner has told you that Telemundo is involved in property development and sales. The object clause of this company is property development and sales. You now told further that the company currently imports more than 60% of its cement requirements. So at a recent meeting of the board of directors, decision was made, okay, to establish a division for the production of cement in Nore. So the company wants to establish cement production in Nore. That means this company is diversifying from property development and sales to now production of cement in Nore. So that's a diversification. So if a company is diversifying and you are asked to calculate appropriate cost of capital, there is no other suitable cost of capital to be computed other than project-specific cost of capital. Why? Because project-specific cost of capital is computed when a company is diversifying from one industry to another industry. So there is a movement from one industry to another industry. Therefore, the existing WACC of 11% will not be suitable to appraise this cement project. So there will be need to estimate a suitable cost of capital that will be consistent with the risk associated with cement production. Therefore, what are we supposed to do? You already know the steps. The first step is to identify the proxy beta of cement. Then step 2, you ungear the beta if it is geared. Step 3, you re-geared. Then step 4, you calculate cappings. Then step 5, you calculate project-specific cost of capital. So we don't need to waste time. Let's quickly solve this question and move to the next one. I will stop sharing this and move to the working notes. Illustration number 14, number 10 rather. Solution. Telemundo. So examiner is asking us to calculate appropriate cost of capital. Number A, I will say calculating project-specific cost of capital. The first step says we should identify the proxy beta. Remember, the project that the company wants to execute is cement production. So you want to determine the appropriate cost of capital that will be suitable to appraise cement production. Therefore, I need beta, proxy beta of cement. So I will say proxy beta of cement production. I need to go to the question and identify the proxy beta. So I will just go to where I have information of a proxy company, because when I was reading, so I've identified the areas I'm looking for. So in the paragraph, you are told that the finance director is of the view that it is not appropriate to use the existing work to appraise the new project. He has identified a listed company which currently produces cement and packaged flow drains. So this proxy company produces cement and packaged flow drains. Therefore, I've identified the proxy company. So let me check the beta of the proxy. In this question, we are told that the proxy company has the following financial statistics: equity beta of 1.82, debt beta of 0.4, then debt equity ratio of 40%. Therefore, what am I supposed to do? Not only that, examiner also gave to you 60% of the market value of the company is attributed to cement production, while 40% is for it's attributable to flow drains. So examiner has not given me, I can't see proxy beta of cement. The only beta I'm given is the beta of both cement and flow drains. This beta of 1.82 is a combined equity beta, because this proxy company is into production of cement and flow drains. Therefore, the beta given to me of 1.82 represents a combined equity beta. So I'm given a combined equity beta of 1.82. Examiner also went further. In the next paragraph, you are told that the flow drains division has equity beta of 0.8. Okay? Examiner also gave to me the equity beta of flow drains, but I'm not given the equity beta of cement. Therefore, I need to use a formula. I have two known variables. I'm looking for one unknown variable. So I'm going to use the known variable to get the unknown variable. So let's go back. I would then say this is not given yet. So the equity beta, let me write that. Of cement is not given. However, the following statistics are available for the proxy. So in this question, we are given combined equity beta, combined equity beta of 1.82. We are given equity beta of cement, of fruits, which is equal to 0.80. You're also given market value of cement to be 60%, which is the same thing as 0.6. We are given market value of fruits to be 40%, 0.4. Okay, so if I'm given this information, I'm looking for beta. Now that examiner has given to me combined equity beta, you remember when we did project-specific cost of capital, when we did the work of the combined activity, WACOCA, our step 4 under WACOCA is to calculate beta asset of the combined activities. So since we have been given combined equity beta of 1.82, that same formula is what we are going to use to compute the beta asset of the cement that is now known. Okay. Therefore, I would then say combine. Let me go further. Since the beta of cement is not given, the formula below can be used. Okay, I would then say combine equity beta equal to beta equity of cement multiplied by total market value of equity and debt of cement divided by total market value of cement and food drinks. On one side, plus, open a bracket, beta equity of fruits multiplied by total market value of fruits divided by total market value of cement and total market value of equity and debt of cement and food drinks. Okay, so this is the formula. You're already familiar with this. So combined equity beta is 1.82. 1.82 equal to beta equity of cement. We don't know it. That's what we are looking for. Multiplied by total market value of cement. Examiner has told us that 60% is for cement. Therefore, 60% is the same thing as 0.60. I will close this, plus, open a bracket. Beta equity of fruits is 0.8 multiplied by market value of equity and debt of fruit drinks is 40%, which is the same thing as 0.4. Therefore, 1.82 equal to 0.60 BEC plus 0.32. I will collect like terms. Therefore, 0.60 BEC equal to 1.82 minus 0.32. Therefore, beta equity of cement equal to 1.50 divided by 0.60. What do you have there? 1.5 divided by 0.6. That's 2.5. 2.5. So that is the answer. Beta equity of cement is 2.5. Now that we have identified the beta equity of cement, the next thing we need to do is to ungear. So step 2, we need to ungear to incorporate financial risk because this 2.5 is geared because the property company has debt in its capital structure. That's why you are given debt equity ratio of 40%. So when I want to ungear, I need to check from the question. Am I given debt beta? According to the question, we are given debt equity, we are given debt beta of 0.4. So we have debt equity of 0.4. Sorry, debt beta of 0.4. So I would then say, since we are given debt beta, so the formula to use would then be beta assets equal to beta equity of a gear multiplied by equity value over equity plus debt, 1 minus tax, plus debt beta multiplied by debt value multiplied by 1 minus tax over equity value plus debt, 1 minus tax. So that's it. Beta assets is what we are looking for. Beta equity of a gear is 2.5. equity value. I will then go to the question, what is the gearing ratio of the proxy company? Examiner has told us that debt equity proportion of the proxy company is 40%. So if debt is 40%, equity will be 60%. Therefore, equity is 60 plus debt is 40. What's the tax rate? Examiner told us that tax rate is 25% for the two companies and is paid in the current year. So if tax is 25%, so we are supposed to account for 75%. That is 1 minus 0.25. That will give us 75. Plus the debt beta, we are told that debt equity ratio is 40%. Debt beta, of course, debt beta is a 40, 0.4, 0.40 multiplied by value of debt is 40%, 0.75 over 60 plus 40 into 0.75. Okay. Then beta assets equal to 0.75 multiplied by 40. That's 30. Therefore, 60 over 90 equal multiplied by 2.5 equal. That's 1.67. Here is 1.67 plus the other side. That will be 30 over 90. 30 over 90 equal multiplied by 0.4 equal 0.13. So when you add it up, beta asset is equal to 1.8. Beta asset is 1.8. So now that I've calculated the beta asset, I need to re-gear to incorporate financial risk of Telemundo. Number 3, I will re-gear. Remember, when you are calculating project specific for step 1 and step 2, you need the information of the proxy company. From step 3 to step 5, you need the information of the main company. The main company in this question is Telemundo. So I need to re-gear now to incorporate financial risk. Before I put down the formula I'm going to use to re-gear, I will go to the question and check if I'm given debt beta for Telemundo, which is the main company. According to the question, we don't have debt beta for Telemundo. So it means that debt beta is risk-free. So that is one way you can solve it. And another way is that you can assume, since you are not given debt beta of Telemundo, you can assume the debt beta of the proxy company. Whichever way you want to solve it, you have to state your assumption at the end of the day. Let the examiner know your position. All right. Again, why do you want to be stressing yourself? Since you are not given the debt beta of Telemundo, just assume it is risk-free and you move on. So I can say since debt beta of Telemundo is not given, it is assumed to be risk-free. Okay, so if that is the case, then my beta equity of a gear will then be calculated as beta assets multiplied by 1 plus 1 minus tax, debt equity proportion of Telemundo. So beta equity of a gear equal to 1.8 multiplied by 1 plus 0.75 multiplied by debt equity proportion of Telemundo. According to the question, we are told that the new projects in the last paragraph, before the requirements, you are told that the new project is expected to move Telemundo PSC to the target to the target debt equity ratio of 30%. So if debt is 30%, equity will be 70%. So debt is 30, equity is 70. So final answer, 30 over 70 equal, multiply by 0.75 equal, plus 1 equal, multiply by 1.8 equal, that's 2.38. 2.38 is the gear beta. Step 4 says you should calculate cost of equity using CAPM. So KE equal to risk-free rate of return plus beta into market return minus risk-free rate of return. So my KE is equal to, go to the question, what's the risk-free rate of return? According to the question, examiner told us that the asset beta of the company is 1.2, equity beta is that, risk-free rate of return is 5%, while the market risk premium is 7. So risk-free rate is 5%. So here is 5 plus beta of 2.38. Risk premium, we are told, is 7%. So the difference between market return and risk-free rate of return is called risk premium, and the examiner has given to us as 7. So KE would then be equal to 7 multiplied by 2.38 equal, then plus 5 equal 21.66. Here is 21.66%. Finally, I need to calculate WACC. So project specific WACC. So KW equal to equity value divided by equity plus debt multiplied by cost of equity plus debt value over equity plus debt multiplied by cost of debt 1 minus tax. All of that multiplied by 100%. So KW equal to equity value. Examiner has told us that debt equity ratio is 30%. Debt is 30, equity is 70. Therefore, 0.7. 70% is 0.7 multiplied by cost of equity of 21.66%. Plus the other side, debt is 30%. So 0.3 multiplied by cost of debt. I need to go to the question. KD is the cost of borrowing, cost of debt, which is interest rates or coupon rates. I will go to the question. If I have anything that has to do with loan with the coupon rates, then that coupon rate is what we are looking for. When you look at the paragraph, where you have after the table for bags of cement, okay, you are told that 50% of the total initial outlay of 2 billion naira is to be funded with a loan from a federal government development bank at a concessional fixed interest rate of 8%. So I've been given interest rate of 8%. That interest rate is your KD, is your cost of debt. That's your cost of borrowing. Therefore, I would then say 0.8. 0.08 multiplied by 1 minus tax is 0.75. Okay, so KW equal to multiply by 0.7 equal 15.16. Here is 15.16% plus the other side, which is 0.3 multiplied by 0.08 multiplied by 0.75 equal 0.2. 0.02%. Okay, sorry, that's a 2. I made a mistake here. This is supposed to be 8. It's supposed to be 8%. So Let me write this. Let me do that again. 0.3 multiplied by 8 multiplied by 0.75. That's 1.8. Here is 1.8%. So add it up. Our project specific work will then be 15.16 plus that. That's 16.96. Here is 16.96%. Okay, approximately our work is equal to 17%. Okay, that's that. So examiner is asking you, you have to compute the appropriate cost of capital that Telemundo should use to appraise the cement project and state why you consider this rate more appropriate. So you should round your number to the nearest, round your cost of capital to the nearest whole number. Okay. So in this case, I would then say Telemundo PLC should use 17% cost of capital to appraise, to evaluate a cement project. Examiner is asking you, why do you consider this cost of capital to be more appropriate than the existing work of 11%? I would then say the cost of capital of 17% is more suitable to appraise the cement projects than the existing work of 11%. This is because cost of capital should be consistent. With the systematic business and financial risk associated with a project. Okay, then, so that's that. Not only that, examiner also told you to state any assumption made. You are not going to earn your entire 12 marks. If you don't do any of these things, if you just do only calculation, you can't earn the entire 12 marks. So what are the assumptions we have made in the calculation of the project specific? So I will then say assumptions. What are those assumptions? Assumption number 1, our assumption on debt beta. We made assumption on debt beta. What assumption? We said that debt beta,
0.
Debt beta of Telemundo is not given. Therefore, it is assumed to be risk-free. So that's one assumption that we made on the computation of the cost of capital. Another assumption is that we also assume business risk. This one is a given under project specific cost of capital. The assumption is that both Telemundo PSC and the proxy company have similar business risk. That's why you are borrowing the beta of the proxy company. So it is assumed that both Telemundo and the proxy company have similar business risk. So if you want to add one more, another assumption is debt equity ratio. Debt equity ratio. So what's our assumption? For the proxy company, I will say 40% debt equity ratio, debt equity proportion of 40% is assumed for the proxy. Okay. It's assumed for the proxy. That is the debt is 40%, equity is 60. Why debt equity ratio of 30%, okay, is assumed for Telemundo. That is debt is 30% and equity is 70%. So these are the assumptions we made in the calculation of the cost of capital. So let me know any question for me so that I can move to B. Any question? All right, so let's go to B. In the B part, you have to calculate NPV and then modified internal rate of return. So let me see if this one can accommodate NPV. We'll manage this space. So number B, calculating, this is B1, calculating net present value. An examiner has told us that we should round our number to the nearest million. So figures in million. According to the question, useful life of this project is 5 years. We are told that tax is paid in the current year, the profit is earned. Therefore, I create a column for year 0, year 1, year 2, 3, 4, 5. Then another column for workings. So I don't know the extent of my table, so I can't rule for now. I will then go to the question. Am I given selling price? Yes, I'm given selling price of 2,000 naira. Therefore, I'm going to calculate sales. So let's go and do our workings. First thing first, I will go back to the question where I have information on selling price. So I have information of selling price, variable cost, then fixed cost, and then inflation. So you are told that a bag of cement sells currently for 2,000 naira. A bag of cement sells currently for 2,000 naira. Open market. The price is expected to increase at the rate of 5% per annum. So the 2,000 naira given to us for selling price is stated in real terms because examiner told you that sells currently, that's current value terms. So if you are given current value term, inflation should start from year one. So in that case, I will go and do my workings. So this one will be for NPV. The second page will be for modified internal rate of return as well as the decision on C. Then we use this one for our workings. So working, I'll create columns. Year one, year two, year three, year four, then year five. Units. According to the question in the first year, bag of cement will be 500,000. Here is 500,000 bags. 650, 600, 650. Okay, 800, 700. So, working number one says selling price in the first, we are told that selling price currently sells for 2,000 naira. So my selling price of 2,000 naira, selling price of 2,000 naira at inflation of 5%. Okay, therefore, I would then say 1.05 multiplied by 2,000. This will give me 2,100 for the first year. What I have in my calculator multiplied by 1.05. That's 2,205. Year three, multiplied by 1.05. That's 2,315. Year four, what I have in the calculator multiplied by 1.05. 2,431. Finally, year five, multiplied by 1.05. 2,553. So with this, I've inflated the selling price. The next thing I need to do is to calculate total sales. Our figures are in million. So let's say this is A, unit is A, then the selling price is B. Therefore, A times B. So figures are in million. 500,000 multiplied by 2,100 equal. So that's 1050. Next one, 600,000 multiplied by 2,205 equal 1,323. Next one, 650,000 multiplied by 2,315 equal 1,505. Year four, 800,000 multiplied by 2,431 equal, that's 1945. Year five, 700,000 multiplied by 2553 equal 1787. So now that I've inflated I've gotten my sales value, I need to go and post. You don't wait until you do all your workings before you post, because on the D-Day, time may not permit you to do all of that. So let's go and post what we have done. 1050. Say for year one is 1050. Year two, 1323, 1323. 1945. 1945. Sorry, 1505. 1505. 1787. 1945. 1505. Okay, working number one. So in the question, we're also given variable costs. Let's go and do our working for variable costs. Okay. Working number two. Variable costs. All right. So according to the question, you are told that variable cost is now 800 naira per bag. Okay. This will increase at 4% per annum. So variable cost of 800 naira at 4%. Therefore, 1.04 multiplied by 800 equal 832. 832 multiplied by 1.04 equal 865. Multiplied by 1.04, what you have in your calculator, that's 900. What you have in your calculator multiplied by 1.04, 936. Finally, multiplied by 1.04, 973. Okay, so total variable cost, let's say this is C. So total variable cost in million, that will be A multiplied by C. So 500,000 multiplied by 832 equal 416. Okay, 600,000 multiplied by 865, 519. Next one, 650,000 multiplied by 900 equal 585. 800,000 bags multiplied by 936 equal 749. Year 5, 700,000 multiplied by 973 equal 681. So let's go and post 416,519. 416,519. $585,749. 585,749.
681, the last one.
681. Working number 2. I will then go back to the question. Is there any other cash flows I need to consider? Still on the same paragraph where you have selling price and variable cost. Examiner has told you that fixed overhead costs will be 50 million naira at current prices, but will rise by 8% per annum. So I want to put to you, class, the fixed overhead cost of 50 million naira, is it relevant or irrelevant? The fixed overhead cost of 50 million naira, relevant or irrelevant?
It appears to be relevant because it's changing with you say a rise by 8% per annum. So is it rising based on the activity of the activity?
Examiner told you that it will rise by 8%. That's inflation rate. So I'm now asking, the fixed overhead of 50 million, is it relevant or irrelevant? Robert is saying
irrelevant.
Why is it not
relevant?
Why is it not relevant?
Because it's a sunk cost. It will remain constant through the period. It's a sunk cost.
Okay. Robert, is it relevant or irrelevant? Robert, relevant or irrelevant? Gloria, relevant or irrelevant? Elvis.
I'm looking at it as relevant because I know that it's increasing because of inflation, but considering the fact that it's changing, that is why I'm looking at it as relevant.
Okay, then. So because of time, you have to be very careful. You know, I explained to you when I was giving you notes on the relevant cash flow. I said fixed costs are costs that have no sympathy for activity level, irrespective of level of production, irrespective of activity level, it will not change. So provided your fixed cost will not change, then it is irrelevant. And I told you, if your fixed cost is incremental, if you are given incremental fixed cost, attributable fixed cost, specific fixed cost, or direct fixed cost, those costs are relevant, you need to account for it. And I also told you specifically that there are 3 ways examiner can test fixed cost. If in the question you are just given fixed cost, no further information, that fixed cost is irrelevant, just ignore it. I also mentioned the second area fixed cost can be tested is that you may be given fixed cost including depreciation. So if you are given fixed cost including depreciation, it means that you need to calculate annual depreciation, then you less from the fixed cost. Whatever you have thereafter is relevant. Then the third way in which fixed cost can be given in the question or can be tested in the question is that you may be given fixed cost excluding depreciation. So if you are given fixed cost excluding depreciation, is relevant and you have to account for it. In this question, is an additional fixed cost because examiner told you that fixed overhead cost will be, it's not a past cost, will be. So they are going to spend it on the project. Fixed overhead cost will be 50 million. So it means that it's a future cost. Remember, your cash flow must relate to the future. So this 50 million is a future cost. The company has not incurred it. Therefore, it is relevant. It's not because of the inflation rate given to you. That's why fixed cost is relevant. No, it's because it's a future cost. They've not incurred the fixed cost. So because of the project, they are going to incur fixed cost of 50 million. And that's why we are accounting for it. So because of time, I will then call me a fixed overhead. I don't need to go and do working for my fixed cost. So I'll just say the inflation rate on the fixed cost we are told is 8%. So here is 8%. The fixed cost is 50 million. Therefore, I would then say I will say 50 multiplied by 1.08. That will give me 54. Next, 54 multiplied by 1.08 equal 58. 58, what you have in your calculator multiplied by 1.08 equal 63. Multiplied by 1.08, 68. Multiplied by 1.08, that's 73. So that's that. Next item, still on the same paragraph. You're also told that apportioned head charges of 25 million at current prices will rise by 10% per annum. So examiner has given us apportioned head charges of 25 million. That apportioned head office charges of 25 million, is it relevant or irrelevant? Yes. Apportioned head office charges, relevant or irrelevant?
It's
Hello,
irrelevant.
class.
It's irrelevant because the company will still incur that cost anyway, anyhow.
Okay, so irrespective for the decision taken on the project, they are going to.
They will still incur it.
Okay, so any other arguments? The 25 million naira, is it relevant or irrelevant?
Irrelevant, sir. Irrelevant.
Why is it not relevant? Debbie, why is it not relevant?
Same thing Robert said. The company will still incur it regardless of the project.
Okay. Elvis, what's your justification? Elvis, what's
Yeah,
your
still I go with your opinion, sir, because it's a cost that will still be incurred, irrespective of the project.
Okay. So your argument does not hold water. Your justification for ignoring 25 million apportioned head charges, it does not hold water. Because you said the cost, the 25 million will still be incurred irrespective of decision on the project. That's not the reason why. It is true that the 25 million naira is not relevant, but you can see examiner was specific by telling you that apportioned head charges, anything that has to do with apportionment, is irrelevant. It's not because the company, the cost will not change, either you undertake the project or not. That's not the main reason that it's not relevant. The reason why it is not relevant is because it's an apportionment. The head office cost that will be incurred, all the rents, all the other expenses, the electricity, the rents, the utility, all those expenses in the head office will be incurred and apportioned to each unit within the organization or apportioned into the project. So it's any apportionment is irrelevant cost, therefore it should be ignored. So the reason why we are not taking the 25 million naira is because it's an apportionment. An apportionment is the same thing as distribution. When you incur cost, then you now distribute it across. So that's why we are not, so you ignore the 25 million.
Mr. Jumo, just 1 second, please. Just indulge me a little bit. You know, you were running through the basis of fixed costs being relevant, right? Some of them, well, one is familiar to them. But you gave 3 scenarios or 4 scenarios. If you don't mind, if you could repeat it, it would be appreciated. One, you said the fixed cost, if there's depreciation, then it's relevant.
I said that if there are 3 ways examiner can test fixed costs or can be given in the question. If you are given fixed costs, no additional information, you are just given fixed costs, 1 million naira, no further information. Ignore the fixed cost, provided the fixed cost will not change. Okay, when you say fixed cost change, it's either, the fixed cost will increase. So in as much as the fixed cost will not change, therefore it is irrelevant. Another way is that you may be given fixed costs, including depreciation. So if you are given in a question, the examiner told you that fixed costs, the company will incur fixed cost of 50 million naira or 10 million naira, including depreciation. So because the examiner has mentioned including depreciation, so it means that you have to do something. You go ahead and calculate annual depreciation. So you now less it from the fixed cost. So whatever you have thereafter is your relevant fixed cost. Then the third area examiner can test fixed cost is if you are given fixed cost excluding depreciation. You are given a scenario that fixed cost excluding depreciation, 5 million naira. So it means that that fixed cost is relevant. You have to account for it. So those are the 3 ways in which examiner can test fixed cost in a question. You must know what to do at the right time. Okay. Yes. So in this, you're welcome. In this same paragraph, no other thing, no other cash flow there. Then we're also given cash flow in the question. If you go back to the second paragraph of the table, of the question.
Hello, sir. What about the incremental fixed cost?
Of course, I've said it already now. The incremental, attributable, direct, specific fixed costs are all relevant. When you're like in this case now, this 50 million naira is an additional cost. It's an incremental fixed cost. So that's why we're accounting for it, because it's a future cost. Sir. Yeah. So when you go to the third paragraph of the question, third paragraph, a total of 20 million naira has been spent on various surveys, market, technical, financial, etc. to date, out of which 10 million naira has been paid. The balance of 10 million naira is due for payment at the end of year 1. So how do we treat that information? How do we treat the information? I'm putting it to you. How do we treat the information?
This paragraph.
The third paragraph in the question. A total of 20 million naira has been spent on various surveys, markets, technical, financial, etc. to date, out of which 10 million naira has been paid. The balance of 10 million naira is due to be paid at the end of year 1. So how do we treat that information? Yes. How do we treat the information? The 20 million
and added to would be included in the initial capital outlay.
So which one? Is it the 20 million?
It's or 20 million has been spent on various surveys, market, technical, financial to date, out of which 10 million has been paid.
Okay.
And 10 million is due for payment at the end of year 1.
Yeah.
So this 10 million that has been paid, I'm saying that it appears to be capitalized, like added as part of the initial capital outlay for this particular project.
Okay. All right. So we had it as part of an initial outlay of 2 billion, right?
Well, that is what it appears.
It's okay. So any other person?
Are we going to expenses?
Any other person? How do we treat the information of market survey? Ayodele? Ibrahim, how do we treat that information? Anyway, I know you guys will not answer. Yes, Mr. Roberts, when you look at the scenario, examiner has told you that a total of 20 million naira has been spent on various surveys. That information alone is sufficient for you to know that the 20 million is irrelevant because it's a sunk cost. When I was explaining to you, when I was explaining the concepts under sunk costs, I mentioned to you that historical costs are sunk costs. They are costs that have already been incurred and therefore irrelevant and should be ignored in the calculation. Now, I give you an example of sunk costs. One of them is market survey, research and development, or development costs. Anywhere you see market survey in a question, or R&D or development costs, they are usually past costs, which is sunk cost, and therefore irrelevant, because that activity could have been conducted before the project commenced. When the company make market survey or carried out market survey because of a project, that market survey would have been done before the project commenced. Remember, your cash flow must relate to the future.
Okay.
Your cash flow must relate to the future. Any cost you incur before the commencement of the project is irrelevant. You ignore it. So this 20 million naira is irrelevant, irrespective of when the money will be paid, because examiner is telling you, examiner wants to test your understand, because examiner is aware of the fact that there will be some average students, because you have been told that out of which 10 million has been paid, then the balance of 10 million is due to be paid. Some student may take 20 million, some student may take 10 million balance, because they said that 10 million is still outstanding, it has not been paid. The activity has been done already. We are told that the company, a total of 20 million naira has been spent on various market survey. Watch out. So that 20 million naira, or whatever you have in that paragraph, they are all irrelevant. Move on. So let's determine, with this, let's determine our...
I think this just shows that somebody is very, okay, that I'm rusty with these relevant costs.
You have to.
Because we did it before now, and it was very straightforward, but anyway, we'll go and revise it.
Yeah, yeah. So please go back to your notes.
We'll revise it. We've done it now.
Yeah,
So
yeah.
just revision.
So let's determine the profits or loss. So 1050 minus 416 minus 54 equal, that's 580. 580, that's the profit. Let me use one stone to kill two birds. Immediately after profit, you need to pay tax. And tax is 25%. Tax at 25%. Okay. Therefore, what's 25%? And tax is paid in the current year. So 580 multiplied by 0.25 equal 145. Then again, 1323 minus 519 minus 58 equal 746. Multiplied by tax 0.25 equal 187. Next one, 1505 minus 585 minus 63 equal 857. Multiply by 0.25 equal 214. Next, 1945 minus 749 minus 68 equal 1128. multiply by 0.25 equal 282. The last one, 1787 minus 681 minus 73 equal 1033. Multiply by 0.25, 258. That's the tax. Immediately after tax liability, you need to claim tax saved on capital allowance. Tax saved. So let's go and do our workings for tax saved on capital allowance. That will be working number 3. Working number 3, tax saved on capital allowance. Okay. So I will then go to the question. How am I going to claim my capital allowance? When you look at paragraph number 2, you are told that the sum of 2 billion naira will be required, out of which the sum of 500 naira will be spent to acquire an existing factory considered suitable for the project. The 2 billion naira is not qualified for capital allowance. However, you are told that out of the 2 billion, 500 million naira will be spent to acquire a existing factory considered suitable for the project. So a company cannot claim capital allowance on an existing asset, Therefore, because the original owner of that asset would have been claiming capital allowance, so you cannot transfer it. The balance of out of the 2 billion, 500 million from that, the balance of 1.5 billion will be applied for the procurement and installation of essential plant and equipment. So that 1.5 billion naira is the qualifying capital expenditure. Okay. And you are now told that capital tax allowance can be claimed. Tax allowance is the same thing as capital allowance. Can be claimed on plant and equipment at a uniform amount over 5 years with NIS scrap value. So I don't need to waste time on this, and I don't need to follow the normal formats for calculating tax saved on capital allowance. Examiners made life so easy for me by telling me that I should calculate my capital allowance on a straight line basis. Therefore, I will say capital allowance equal to the cost minus the scrap value divided by the useful life of the project. Okay, so the cost of this plant and machinery is 1.5 billion. Figures are in millions, so 1.5 billion minus scrap value of 0. We don't have scrap value. Divided by the useful life of 5 years. Therefore, my annual capital allowance is equal to 300 million. Okay, that's my capital allowance. Therefore, I would then say tax saved on capital allowance, which is equal to capital allowance multiplied by company tax rates. So capital allowance is 300 million multiplied by 25%. So this will give me what? 0.25 multiplied by 300. That's 75 million per annum. So my annual tax saved is 75 million. So let's go and claim that. That will reduce the tax liability for the company. So 75 is a claim, 75, 75, 75. That's working number 4. Is it number 4, number 3? Working number 3. Then after this, we are supposed to have a scrap value or sales proceed. We are told in the question there is no scrap value, so you ignore. Then the next item will be initial outlay. The initial outlay of the question is 2 billion, of the project is 2 billion. We are following a format. After the initial outlay, the next item would be working capital. So I will then go to the question, how are we going to calculate working capital? Where is the information on working capital? Working capital, I saw it somewhere. So in the paragraph where you have the selling price, variable cost, and fixed cost, you are told that the project will require a working capital of 10% of annual revenue, and this should be applied at the beginning of each year. So that's a working capital of 10% on annual revenue. So let's go and work that out. Working number 4, working capital. Here is working number 4. Working capital. Year 1, year 2, year 3, year 4, year 5, then total. Okay, you are told that working capital are 10% of sales. All right, so the sales of year 1 is 1050. 10% of 1050 is 105. In year 2, sales is 1323. 10% of that is 132. In year 3, 10% of 1505, that's 151. In year 4, 10% of 1945, that's 195. In year 5, 10% of 1787, that's 179. 179. So when you look at the working capital, you notice that the working capital is increasing from 105 to 132, 132 to 151, 151 to 195. Then it starts dropping to, and it dropped to 179. Therefore, that means the highest working capital for Telemundo is 195. So when you get to a point where your working capital is increasing and it starts falling at a particular point, it means that the company has recovered part of the working capital. So out of the 195 million, so part of it has been recovered. That's why it's reduced to 179. Therefore, I need to determine my incremental working capital. I don't need 132, 151, 195, or 179. What I need is the incremental. So I will then come here, incremental working capital. The first year working capital is 105. 105. 105 has increased to 132. I will say 132 minus 105 equal 27. The increment is 27. Then 151 minus 132 equal 19. Next one, 195 minus 151 equal 44. Then 179 minus 195 equal, that's 16. Okay. Finally, the highest, once I would then say 179 minus 0, or 0 minus 179 will give me 179. Now, when I was explaining what
16 is not incremental.
Don't worry. when I was explaining the concept of working capital to you, I mentioned to you that working capital can be treated in two different ways. One is a one-off working capital. When you are given a one-off working capital, it should be treated as cash outflow in the year before the year of occurrence and recover fully at the end of the useful life of the project. The second one is incremental working capital. The incremental working capital should be treated the same way as a one-off working capital, except that only the increment should be considered. Therefore, we have considered the increment as far as this question is concerned. So the working capital of year 1 should be treated as cash outflow in year 0. The working capital of year 2 should be treated as cash outflow in year 1. The one of year 3, cash outflow in year 2. The one of year 4, cash outflow in year 3. Like I mentioned to you, when working capital is increasing and it starts falling at a particular point, it means that the company has recovered part of the working capital. When you add up the 103 plus 27 plus 1 plus 19 plus 44, that will give you 195. It means that the highest working capital is 195 million. So the 16 million you have here is a recovery. It's a recovery from the 195. The company has recovered part of the 195. Therefore, that 16 million recovery will be recovered was recovered in year 4. Then, of course, the final one, which is the balance of 179, will be recovered in the 5th year. So when you add up 105 plus 27 plus 19 plus 44, that will give you 195. When you add up 16 plus 179, that's another 179. It means that the company has recovered the entire working capital. So this is how to treat the working capital in this question. So let's go and post 105.27. 105.27. Okay. 27.
1944.
1944. Okay, 1944. Then 16, 179. Working number 4. All right, so at this point, I need to determine the net cash flow. Here is 2105. So 580 minus 145 plus 75 minus 27 equal 483. 749, 746 minus 187 plus 75 minus 19. 615.
674, yeah.
674, thank you. Okay. 1033 minus 258 plus 75 plus 179. 1029. Okay.
Yeah, 4.
Yeah.
937.
937. So this represents the net cash flow. With this net cash flow, I can calculate using any technique. I can use NPV, I can use payback period, I can use adjusted present value, I can use internal rate of return, modify internal rate of return, project duration, any technique with this net cash flow. So after this, I need to discount the cash flow at examiner asked us to assume we are to use 13% cost of capital. So here is 13%. So I need to calculate for year 1, 1.13, sorry, 1.13 raised to power 1 minus equal 0.885. 0.885. Discount factor for year 2 raised to power 2 minus 0.783. Um, 1.13 raised to power 3 minus 0.693. Then 1.13 raised to power 4 minus 0.613. Finally, 1.13 raised to power 5 minus 0.543. So I need to get my present value. The present value, 2105, 483 multiplied by 0.885. That's 427. Okay, 615 multiplied by 0.783. 482. Next, 674 multiplied by 0.693. 0.693.
467.
467. Then 937 multiplied by
574.
574. Then the last one, 1029.
That's 559.
559. So let's add up. Add up the positive present value minus the negative. Final answer, what do you get? 427 plus 482 plus 467 plus 574 plus 559 equal minus 2105 equal. What do you get?
404.
404. So that's the NPV of the project. That's the NPV of the project. Now that you have gotten the NPV, examiner is asking you to calculate both NPV and then the modified internal rate of return. So the B part, the B2, I would then say B2, calculating modified internal rate of return. Remember, when I was explaining the concepts, I said I gave you two formulas that you can use to compute the modified internal rate of return. I said there are two methods. One is to use terminal value method, or two, you use present value method. And I told you if in the question examiner has asked you to calculate NPV and you are then asked to calculate modified internal rate of return, and that you should always use the present value method to do that because it will be faster. So instead of me to go ahead and calculate terminal value, even though whether you use terminal value or you use present value, you are going to get the same answer. But in this situation, since I've already calculated NPV previously, there's no need for me to go and use terminal value. It's a waste of time. All right, I will just use present value and I will get my answer. So to use the present value, of course, we said modified internal rate of return is calculated as present value of cash inflow. Cash inflow is the same thing as return phase cash flows divided by present value of cash outflows. Okay, present value of cash outflow is the investment phase cash flows. All right, raised to power 1 over n multiplied by 1 plus the cost of capital all of this minus 1. Okay? So this is the big for nothing formula for modified internal rate of return. So I need to go to the question, to my solution to go and pick present value of cash inflow. To get the present value of cash inflow is what you have determined, is what you have added together to get the NPV. So for me to get my present value back, the positive present value, so I need to add NPV plus cash outflow. That is 404 plus 2105. That will give me 2509. I will say 2105 plus 404. That will give me the present value of cash inflow divided by present value of cash outflow of 2105. Okay, all of this raised to power 1 over 5. 1 over 5 multiplied by cost of capital we have used is 13%. Examiner say we should assume 13%, so 1.13. All of this minus 1. You can see it's a big for nothing. There's nothing there. Don't get scared whenever you are asked to calculate modified internal rate of return. It's very straightforward. So here is 2509 divided by 2105 raised to power 0.2. 1 over 5 is the same thing as 0.2 multiplied by 1.13. Okay, all of this minus 1. So use your calculator and get the final answer. Modified internal rate of return equal to, bring out your calculator. I will say 2509 divided by, take it again, 2509 divided by 2105 equal raised to power 0.2 equal multiply by 1.13 equal minus 1 equal multiply by 100 equal, that's 17%. Here is 17%. So modified internal rate of return is 17%. Finally, examiner is asking you to recommend whether the project should be accepted or not using both NPV and then modified internal rate of return. Before you go to the C part, you have to state your assumption. You can see in that number B, examiner did not ask you to advise. You are not asked to state your assumption, but it is implied in the question. You cannot earn your 16 marks if you don't state your assumption, because there are some figures in the question that you ignore. Why did you ignore them? So you have to state your assumption. So I can then come here. I can say assumptions. So the calculation above, I will say the calculation above is based on the following assumptions. Number 1, whenever you want to state your assumption, it's a given. You must talk about cash flow. What's your assumption on cash flow? Generally, the assumption for cash flow is that the cash flow estimates all those selling price, variable costs, the fixed costs were given in the question. Those are the estimates. The cash flow estimates are realistic and will occur at the end of each year. So that's our assumption. I can then state further that all relevant cash flows have been inflated at the appropriate inflation rates. So that's my assumption on cash flows. Number 2, you can talk about cost of capital. Okay, what's the assumption on cost of capital given of 13%? I can say it is assumed that the cost of capital is appropriate and consistent with the risk associated with the project. That's our assumption on cost of capital. If you like, oh, no space again. Okay, let me go down there. Number 3, you can talk about inflation. Okay, you can talk about inflation. What's our assumption on inflation? So you say it is assumed that the inflation rate will remain constant, will not increase, will remain constant within the period under consideration. Okay, that's our assumption on inflation, because if the inflation increases, if the inflation changes, certainly our decision to accept the projects may change. For example, if your inflation rate on fixed cost or variable cost increases, okay, in that case, the decision to accept the projects may not hold water going forward. May change as a result of that. So our assumption is that the inflation rates will remain constant within the relevant range. Okay, it will not change. All right. Then another assumption is sunk cost. I will then go to the question, am I given sunk cost? If in the question you are given, of course, you are going to have cash flow. If in the question you are given inflation, you're also given cost of capital. These are the things, it's a given. So these are the kind of the assumption you are going to state on the day of your exam. Once you are given inflation in the question, so you're also given cost of capital, of course, there must be cash flow. So these are the things, there's nothing that will be different from all these assumptions. Just memorize it and pour it down on that day. But you can't just write the following are the assumptions associated with this project. Number 1, cash flow. Number 2, inflation. Number 3, sunk cost. Number 4, cost of capital, without stating what you really actually do. So you have to. So under the sunk cost, I will then come here, the market survey. The market survey cost of 20 million naira is a past cost. It's a sunk cost. Instead of you to use past cost, use sunk cost. Sunk cost is a terminology. It's a sunk cost and therefore irrelevant. And therefore irrelevant to the calculation. Okay, that's it. This is okay. So if there's any other assumption that you have made in the question, you state it there, just the way we have done. So that's end of the. Now, finally, in the question, number C, you have to recommend whether the project should be accepted or not using both NPV and then modified internal rate of return, bonus 2 marks. So I will then come here, number C, recommendation. Okay, examiner says you should recommend whether the project should be undertaken using both NPV and then modified internal rate of return. So what are you supposed to do? So you say the projects produced a positive NPV of 404 million naira and modified internal rate of return of 17% relative to the company's cost of capital of 13%. Therefore, the project is financially viable and should be undertaken. The project is financially viable and should be undertaken. 2 marks. You pocket the 2 marks. So that's end of the question. When you do it this way, or the same way, all the calculation we have done so far, you have potential to hang between 25 and 30 marks. Okay, you have potential to hang between 25 and 30 marks. So if the examiner is happy with your calculation and the way you have stated your assumptions, examiner can give you the entire 30 marks. So if examiner take exemption from your presentation and all of that, then it may be given between 25, 26, 27, 28, 29, or thereabout. All right? Because presentation is also part of your mark. You can't just present your work anyhow and you annoy the examiner and think that you are going to earn the full mark. No, because at this level, you are seen as being representing the institute. You are seen as being representing your company. You are seen as being defending a proposal with your clients. Therefore, anything short of a professional will not be accepted from you. And a good presentation will earn you good mark as well. So it's always better for you to have good handwriting. At the same time, you present your work professionally, not anyhow. Okay. This one that I did, my NPV calculation, that I just, without ruling the table, this is not permitted. You can't just do one side and figure out the other one. You have to, that's the essence of ruler. On the day of your exam, you go to the exam hall with your ruler. You rule your table appropriately. You can't just leave it empty like this without ruling it. This is not permitted. Okay, this is not permitted. So you have to rule your table accordingly. So that's end of the question. Let me know if you have any questions so far so that we can move to the last one. So yes, talk to me. So if there's no further question, so we'll solve another one. Yeah. So let me stop sharing this. Let's solve another illustration. Okay. Yeah. So let's solve this illustration number 5. Let's solve illustration number 5. Femi Appliances. I need one of you to read. Who will help us to read? If you are waiting for me to read, you are joking. One of you must read tonight. No worry. I don't need to be asking. I'll just call one of you. Let me see. It was Mary that read for us last time. Yes, Debbie, read, please. Debbie, read.
Femi Appliances Limited is a Nigeria-based manufacturer of household appliances with many distribution centers across various locations in Nigeria and along the ECOWAS sub-region. FAL Femi Appliances Limited is now considering the development of a new motor vehicle vacuum cleaner. The product can be introduced quickly and has an expected life of 4 years change with a more efficient model. Costs associated with the product are estimated to be direct cost per unit, labor, 3.5 skilled labor hour at 500 per hour, 4 unskilled labor hours at 300 naira per hour, material, 6 kilo of material Z at 146 naira per kilo, 3 units of components P at 480 naira per unit, 1 unit of component Q at 640 naira. Other variable cost, 210 naira per unit. Indirect cost, apportionment of management salary, 10,500,000 per year. Tax allowable depreciation of machinery, 21 million per year. Selling expenses, not including any salaries, 16,600,000 per year. Apportionment of head office cost, 5 million per year. Rental of building, 10 million naira per year. Annual interest charge, 10,400,000 naira. Other annual overheads, 7 million, including apportionment of building rates, 2 million. Rate at local tax on property. If the new product is introduced, it will be manufactured in an existing factory and will have no effect on rates payable. The factory could be rented for 12 million naira per year, not including rates. To another company, if the product is not introduced, new machinery costing 86 million will be required. The machinery is to be depreciated on a straight line basis over 4 years and has an expected salvage value of 2 million naira after 4 years. The machinery will be financed by a 4-year fixed rate bank loan at an interest rate of 12% per year. Additional working capital requirements may be ignored. The new products will require 2 additional managers to be recruited at an annual gross cost of 2,500,000 naira each, and 1 manager currently consisting of 2 million naira will be moved from another factory where he will be replaced by a deputy manager at a cost of 1,700,000 per year. 70,000 kilos of material Z are already in inventory and are not required for other production. The realizable value of the material is 9,900,000 naira. PAL will use the existing advertising campaigns for its distribution center to also advertise new products. This will save approximately 5 million naira per year in advertising expenses. The price per unit of the product in the first year will be 100,000 naira, and demand is projected at 12,000, 17,500, 18,000, and 18,500 units in year 1 to 4 respectively. The inflation rate is required to be 5% per year, and prices will be increased in line with inflation. Wages and salary costs are expected to increase by 7% per year, and all other costs, including rent, by 5% per year. No price or cost increases. Sorry, no price or cost increases are expected in the first year of production. Income tax is at the rate of 35% payable in the year the profit occurs. Assume that all sales and costs are on cash basis and occur at the end of the year, except the initial purchase of machinery, which would take place immediately. No inventory will be held at the end of any year required. A. Calculate the expected internal rate of return associated with the manufacture of VC4 through all workings to the nearest million. B. What is meant by an asset beta and how it is different from an equity beta? II. If you are told the company's equity beta is 1.2, the market return is 15%, and the risk-free rate is 8%, discuss whether you would recommend introducing the product. C. The company is worried that the government might increase corporate tax rates. Advise the directors by how much that the tax rates would have to change before the product is not financially viable. A discount rate of 70% per year may be assumed for Part C.
Thank you very much, Debbie. That is the question. You can see it's a very big one. It's a very big question, and the examiner wants you to calculate the expected internal rate of return. One thing is certain in this question, that if you don't have deep knowledge of performance management, how to identify relevant costs, certainly you are going to struggle to solve this question. And then, so that is the question. You want to calculate internal rate of return. There is nothing different between IRR and the NPV that you have computed. It's the same principle, it's the same concepts, only that you are going to calculate two different NPV. When you want to, like in this case, the best approach will be that in order not to make mistake, when you are given this kind of a question on the day of your exam, the first thing you need to do is to identify all the relevant cash flows, okay? You identify all the relevant cash flows. And one thing the examiner did not do in this question is that apart from selling price, every other relevant cash flows, you are not given the first year price. So first thing you need to do is to determine the first year price, because when you look at the paragraph, okay, when you look at the paragraph where you have the selling price, you are told that the price per unit of the product in the first year will be 11,000 naira. So that price per unit is the selling price per unit. So, and that selling price of 11,000 naira is the first year price. So if you are given first year price, that means you start inflating from year 2, because the first year, the first year is the base year price. So you need to inflate that when you get to in the second year. Now, so apart from the selling price of 11,000, every other cash flows were not given. You are not given the first year price. So what that means is that you need to go ahead and calculate all your variable costs. In this case, you have direct labor, okay? You have your direct cost, the same thing as variable cost or marginal cost. So you have direct labor. So there are two types of direct labor. We have skilled labor and unskilled labor. We also have direct material. There are three areas on material. We are told that 6 kilos of material Z, okay? Then we are also told that there's a component. The project will also require 3 units of component P. It will require 1 unit of component Q, and then other variable costs. All these things, all these costs, you need to determine the first year price first. So once you determine the first year price, then you inflate at the appropriate inflation rate. So every other cash flow begin to pick it one after the other. So because of time, let me stop sharing this and move to the working note so that we can quickly solve this question wherever we stop. Then that will be it. Then in our next class, we continue from there. Stop. They move to working note. Okay. Right then. Illustration number 4. Solution to illustration 4, 5. Okay. The name of the company is Femi Appliances. Okay. Then examiner wants you to calculate internal rate of return. Like I said, so your internal rate of return cannot take more than 1 page. So you give this page, the first page for your internal rate of return. Then for the B, after that, then you do your workings. Okay. After that, you do your workings. So working will start from here. Let's go back to the question, requirements. Requirement number 8 is IRR, netting marks. So 1 page is sufficient for that. 1 page, let's see. Well, 1 page should be sufficient for that. Let me see. Let me just create an additional page here. So let me start my workings from here, just in case there's an extension. So workings. Now, like I said, in this kind of a situation, you don't have to rush, and you don't make this kind of a question your first attempt. Otherwise, you are going to struggle. Once you make this kind of a question your first attempt, 1 hour, 2 hours, you are still solving. You won't know that time is already gone. So that's why it is important. You go to the questions, number 1 to 7. Pick the cheaper ones first. Pocket like 3 or 4 cheaper ones. Then come and waste your time on the compulsory. Take your time, articulate the question, and think about articulate the way you are going to present your work. Okay, because when you solve it anyhow, you're also going to gain, you're going to earn anyhow marks, because this is 30 marks question. So you must maximize, you should always aim between 25 and 30. All right then. So the first item, according to the question, is selling price. Okay. The first item is selling price. No, what am I saying? The first item is the direct cost. Under direct cost, we have labor. We have labor. Why is this one sharing? Your screen is sharing. Your screen sharing is paused. I believe you can still see my screen, right?
Yes, sir.
Okay. So that information is in material. So yes, the first item is labor. So we want to determine labor cost per unit. So first, working number 1, labor. So how do I get my labor? There are 2 types of labor. We have skilled. For skilled labor, according to the question, we are told that 3.5 hours at 500 naira. So here is 3.5 hours multiplied by 500 naira. So what do you have there? Please, you have to support so that we can quickly complete this question. 3.5 multiplied by 500, what do you have?
1,750.
1,750. Then we also have unskilled labor, which is 4 hours at 300 naira. 4 hours multiplied by 300, which is 1,200. When you add it up, that's 2,950. So the first year price for labor cost is 2,950 naira. Now that I have the first year price, I need to inflate the labor cost. I would then say year one, year one, year one, year two, year three, year four. What's the useful life of the projects? 4 years is the useful life of the projects, and tax is paid in the current year. So I don't need to stress myself. So let me extend. Okay, no need. I will just say labor cost. Examiner has told us that all cash flows is affected by inflation of 5% except labor. Labor is 7%. So since inflation rate on labor is 7%, I would say at 7%. So the first year price is 2,950. Therefore, 2,950 multiplied by 1.07 equal, that's 3,157. Here is 3,157. What you have in your calculator multiplied by 1.07 equal 3,377. What you have in your calculator multiplied by 1.07 equal 3,614. Then you multiply with number of units. Number of units for the first year is equal to 12,000, 17,500, 12,000, 17,500, 18,000, then 18,500. Please multiply. What do you have? Total. What do you have? Yes.
3540.
3540. Remember, our figures are in millions. Examiner said we should restrict it to million. So that will be 35.
Yes, 35.
35 million. Okay. Let me pick the last one. 3,614 multiplied by.
Second one, 55.
Pardon?
The second one, year two, 55.
Yes, 55 million. Okay.
The third one is 61.
61. So those are the sales. Sorry, those are the total labor costs. So I will then move to working number 2 now. Go back to the question. We're also given materials. So we have 6 kilos of material Z at 146 naira per kilo. So I will say material Z. Material Z. Okay. Year 1, year 2, 3, and then 4. Okay. So material Z at inflation of 5%. Okay, the first year price is 146. Therefore, 146 multiplied by 1.05 equal 153. What you have in your calculator multiplied by 1.05 equal 161. Multiplied by 1.05 equal 169. So we have inflated material Z. We have inflated material Z. The next thing we need to do, now we need to multiply this with kilos. Remember, material Z is in kilos, not in units. Material Z is in kilogram, not in units. So if you are given in units, you need to convert it to kilo, and you are given 6 kilo per unit. Therefore, I need to go and calculate actual kilos. Okay? I will multiply with actual kilos needed. So let's go and do working for kilos. Actual kilos. So units. For the first year, the unit for the first year is 12,000. Okay. Followed by 17,500, 18,000, then 18,500. So you are told that 6 kilos per unit. So multiply by 6 kilos. So multiply by 6. So that will give us total kilo. So 12,000 multiplied by 6 will give us 72,000. Yes, give me the other ones.
105,000.
105,000. The next one, 108,000. And then I think 111. Oh yeah, what do you have there?
111.
111,000. So these are the actual kilos needed. Ordinarily, I'm supposed to multiply this total kilo with the price per unit. Okay, but in the question, the examiner has told you that the company has 70,000 kilos in the inventory. Well, if you go to the paragraph, there's a particular paragraph, yes, where you have deputy manager. That paragraph where you have deputy manager, you are told that 70 kilos of material Z are already in inventory and are not required for other production. Okay, so the company has, remember, when you did performance management, when you talk about material, two things can happen to material. It's either you have the material in stock or the material is out of stock. If the material is in stock and in frequent use, relevant costs represent the current purchase price. That is the amount you are going to purchase the material. But if the material is in stock and then will not be used, then relevant cash flow will then be the disposal value arising from the, it's a saving arising from the disposal. All right. So in this case, examiner has told you that 70,000 kilos of material Z are already in the inventory. That means the company is not buying 70,000, that's 70,000 kilos. The company is not buying it. So of course, already the company has purchased, spent money to purchase this and put it in the warehouse or in the stock. But in this case, that 70,000, you need to less it in the first year. So I would then say kilos in inventory. In inventory. $70,000. You less. Out of the 72, you have 70 in the warehouse or in stock. So it's only 2,000 kilos that you need. So here will be 2,000. Okay. 105. 108. 111,000. So these are the actual kilos needed. Okay, so I need to go and multiply that with the price. So here is 2,000. This next one is 105,000 kilos, 108, then 111,000. So what's the total? 146 multiplied by 2,000. That's 292,000. Remember, our figures are in thousands, are in millions. So total in millions. So 292,000 is the same thing as 0.3 million. All right. Then also 153,000. 153 naira multiplied by 105. That's 16 million. Figures are in millions. So rounding is 16. The next one, 161 multiplied by 108,000 equal. That's 17 million, rounding. Also, 169 multiplied by 1,100,000. That's 19. So that's that. That's that. In addition to this, examiner also told us that the realizable value of the material is 9.9. You are told that the 70 kilos of material Z are already in inventory and are not required for other production. The realizable value of the material is 9.9. Okay, so if the company wants to dispose of this material, this 70 kilogram, the company will earn 9.9 million naira, but the company will not be able to sell it because of this contract, because of this project. They are going to use it for the project. So, but the company will not be able to earn that benefit. That is opportunity cost on the material. Okay, it's an opportunity cost. Ordinarily, if the company wants to sell it, they are going to earn 9.9. But because they are going to use it for this project, they can't sell it. So as a result, the company is losing that benefit. So that is what is called opportunity cost. So I would then come here, opportunity cost, which is 9.9. 9.9 is the same thing as 10. But let me just put 9.9. All right. So total. So 9.9 plus 0.3, that's 10.2. Rounding, that's 10. So 16, 17, then 19. So I'm done with material Z. I'll move to the next one. After material Z, I also have, there's also components P. So I'll go to component P. Number 3. Component P for year 1, year 2, year 3, year 4. First thing first, before this, for the component P, you need to determine the first year price. So you are told that 3 units of component P are 480. So component P equal to 3 units multiplied by 480 naira. That will give 480 multiplied by 3, 1440. 1,440 per component. So I need this. So inflation for year 1, year 2, year 3, then year 4. So component P, the inflation rate, the first year price is 1,440. Inflation rate is 5%. It is only labeled at 7%. Therefore, I would then say 1,440 multiplied by 1.05 equal, that's 1,512. Multiplied by 1.05 equal 1,588. Multiplied by 1.05 equal 1,667. Okay, then I'll need to multiply this with units. The units for the first year is 12,000, followed by 17,500, 18,000, 18,500. So what do you have here? The first year, 1,440 multiplied by 12,000. That's 17 figures and a million. Give me the numbers. $15,120 multiplied by 17,500. That's 26. 1,588 multiplied by 18,000. 29.
Last one is 31.
31. All right, then. So we are done with component P. Number 4, component Q. According to the question, we are told that 1 unit of component Q at 640. So it's only 1 unit. So component Q Q equal to 1 unit multiplied by 640. So which is 640 per year or per component. So year 1, year 2, 3, and 4. Component Q at 5% inflation. The first year price is 640. Therefore, 640 multiplied by 1.05 equal, that's 639.
672.
639. I got 639. 63. Is it? No? That's a mistake. That's a mistake. Oh, instead of multiplication, I use minus. Sorry, 640 multiplied by 1.05. That's 672. Okay, multiplied by 1.05, 706. Multiplied by 1.05, that's 741. So you multiply with number of units. You can see, when you see somebody to explain for you, it's more interesting. But when you're on your own, you will get scared and they're confused on what to do. That's why it's good to attend classes. Life will be made easier. Total in million. So multiply for me. What do you get?
77.
Pardon?
77 for the first one.
77. Here is 77. Okay. Are you sure? This one gave
Is
me
it 7
13.
or 77? 7.
That's,
The
that's
first
to be
one is
That
said.
should
7.
be 8.
It's 8. 8
It's
million.
8.
Year 2, 11.
Year 2 is 11. Then this should be 14 then. Please confirm. Year 4, what do you have?
Year 2
Year
is
2 is
12.
12.
Year 2 is
Pardon?
12. Year
12.
2 is 12.
Okay, year 2 is 12. So is year 4 correct?
Yes, sir.
Okay, then. So the next one, after component P, the next one is other variable cost. Okay, other variable costs. We are told that other variable cost is 210 naira. 210 naira per unit. So I will then calculate. I want to inflate year 1, year 2, year 3, year 4. Other variable costs at 5%. First year price is 210. Therefore, 210 multiplied by 1.05 equal 221. What you have in your calculator multiplied by 1.05, 232. Multiplied by 1.05, 243. So you multiply with number of units, 12,000, 17,500, 18,000, 18,500. Multiply, what do you get?
First year, 3 million.
That's 2.5, that's 3 million. Okay.
Year
Yes.
2, 4.
Year 2, 4.
Year 2, 4.
Year 2, 4. That means year 3 also is
Year
4.
3, 4.
Okay, then. So the next one, after other variable costs, then we have indirect costs. The first item under indirect costs is apportionment of management salaries, 10.5 million per year. And I've told you already, anything apportionment is irrelevant. Therefore, you ignore the 10.5. It's not relevant. The next item, tax allowable depreciation of machinery, 21 million naira per year. So when we want to determine capital allowance, we take that figure. The next one is selling expenses, not including any salary, 16.6 million. So we have selling expenses. Selling expenses is a relevant cash flow. You have to account for it because any selling expenses that the company will incur as a result of the project are relevant, whether fixed or variable, provided it's a selling expenses. Because if you don't incur the selling expenses, the company will not be able to execute, it. So that's why whenever you see selling expenses, either variable or fixed, it's relevant. You have to account for it. So I would then say selling expenses for year 1, year 2, year 3, year 4. Selling expenses at 5%. The first year price is 16.6 million. So 16.6 rounding, that's 17 million. The examiner says you should round your number, remember. So 16.6 million is the same thing as 17 million. So if that is the case, pay attention to what I'm about to say. Because the first year price is 16.6. So in your own calculator, you are going to put 16.6. That's the first year price. So multiply by 1.05. Don't go and inflate 17 million. So you are inflating 16.6, not 17 million. So because 16.6 in the first year is what you rounded up to 17 million. But in your own calculator, when you want to inflate for year 2 to 4, so you are going to do 16.6 in your calculator multiplied by 1.05. That will give us 17.43. So you write down 17. So what you have in your calculator multiplied by 1.05 equal to 18. Then the last one multiplied by 1.05 equal to 19. So that represents this is the sales selling price. That's the total selling price, total in million. So I'm done with that. I'll move to the next one. So we also have apportionment of head office costs, 5 million naira. Again, anything apportionment is irrelevant, you ignore. We have rental of buildings, 10 million naira per year. Rentals of buildings, 10 million naira per year. So rentals of building, whether you execute this project or not, the company must pay for the building rents. So that information is irrelevant, ignore it. Annual interest charges, 10.4 million. I've already told you when I was explaining the concepts under relevant cash flow. Anything interest expense, any naira amount of interest is irrelevant because the cost of capital to be used to execute the project or to discount the cash flows already included the interest. So if you now consider this 10.4 million, that means you are treating interest twice. That means you are double dipping. So you ignore the 10.4, it's irrelevant. Other annual overheads, 7 million naira, including apportionment of building rates of 2 million. So in this case, examiner has told the other annual overheads. So when you are given other annual overhead, it's not clear whether it is variable overhead or fixed overhead. But because of the additional information given in the question, Examiner has told you that including apportionment of building rate of 2 million naira. So what you need to do is to less 2 million from 7 million. That means the 5 million is relevant. That's what we are going to do. So I will then come here, working number 7, other overheads. Okay. For year 1, year 2, year 3, then year 4. At 5%. So let me rewrite this so that it will be clearer. Other overheads will then be equal to 7 million minus 2 million, which is equal to 5 million naira per annum. So I will do for year 1, year 2, year 3, then year 4. Okay, other overhead at 5%. The first year price is 5 million. Therefore, 1.05 multiplied by 5 equal to 5.25. Just put 5 there. Multiply by 1.05 equal 5.5. That is 6. Multiply by 1.05 equal 5.7. That's 6. So that's it. Total 5, 6, 6, 6, 5, 5. So I'm done with that information. Move to the next one. So you're also told that if the new project is introduced, it will be manufactured in an existing factory and will have no effect on rate payable. The factory will be rented. The factory could be rented for 12 million naira per year, not including rates, to other company if the product is not introduced. So this is called opportunity cost. There's an opportunity cost on the rent. Working number 8. Opportunity cost. Opportunity cost on rents. So the company will not be able to earn this 10 million because of the projects. So that's an opportunity cost. Let me write that. Year 1, year 2, year 3, year 4. Okay. So that's 12 million naira. Opportunity cost at 5% inflation. The first year is 12. Therefore, 12 multiplied by 1.05 equal to 13. Multiplied by 1.05 equal to 13. Multiplied by 1.05 equal to 14. So that's the opportunity cost we are going to post. Let's save time. I have to finish this question. So number 9. Number 9. Move on to the next one. The next paragraph. New machinery costing 86 million naira will be required. The machinery is to be depreciated on a straight line basis over 4 years and has an expected salvage value of 2 million naira after 4 years. So the 86 million naira is the initial outlay. So salvage value. So the machinery will be financed by 4 years. We are less concerned with method of financing the projects. So now, you are told that the next paragraph, the new product will require 2 additional managers to be recruited at an annual gross cost. So 2 additional managers, so additional labor cost. Additional labor cost. What are they? We are told that 2 additional managers. So I will say managers equal to 2 of them at a rate of, where is that information again? Yes, 2.5 million at the rate of 2.5 million naira, 2,500,000, which is the same thing as 5 million, figures in million. Okay. Then you're also told that and one manager currently costing 2 million naira will be moved from one factory from another factory where it will be replaced by a deputy manager. So the person earning 2 million naira, the company will not pay anything. So the person that currently earns 2 million naira will not be paid, because whether you execute this project or not, that 2 million naira will be paid. However, because you are moving the person to come and execute this project, the person will need to be replaced by a deputy manager. So that replacement cost, the cost you are going to pay to the deputy manager, which is 1.7 million naira per year, is relevant. So I would then say deputy manager, deputy, let me give space, manager, which is equal to 1 times 1,700,000, which is equal to 1.7. Okay, 1.7, 1.7. So when you add it together, that will be 6.7. 6.7 is the same thing as this is total additional labor cost, 6.7 million. So we need to inflate that. Year 1, year 2, year 3, then year 4. So additional labor cost at 7%. Remember, inflation rate on labor is 7%. The first year price is 7 million. 6.7 is the same thing as 7 million rounding. Therefore, I would then say 6.7 multiplied by 1.07 equal to 7. Okay, multiplied by 1.07 equal to 8. Multiplied by 1.07, 8. So I'm done with that. I don't need to stress myself. Then next. Still on that same paragraph, I think we have used all the information we have in that paragraph. The next paragraph, we are told that FAL will use the existing advertising campaign for its distribution centers to also advertise the new product. This will save approximately 5 million naira per year in advertising expenses. So because of this, since the company will not incur additional advertising costs on this project, so that 5 million naira is irrelevant. You ignore it. So move to the next paragraph. So the price per unit of the product in the first year will be 11,000. So says selling price. Number 10, working number 10. Yeah, selling price. Okay. This selling price of 6. Says for year 1, year 1, year 2, year 3, then year 4. Selling price at 5%. The first year price is 11,000. Therefore, 11,000 multiplied by 1.05 equal to 10,550. Sorry, 11,550. Then multiply by 1.05, 12,128. Multiply by 1.05, 12,734. Okay, then you multiply with number of units. 12,000, 17,500, 18,000, 18,500. 500. Total sales, 1,000,000. So 11,000 multiplied by 12,000 equal, that's 132. So we're almost there. 11,550 multiplied by 17,500. That's 202. This working is the major one. 12,128 multiplied by 18,000. That's 218. Then the last one, 12,734 multiplied by 18,500. That's 236. 236. That's it. So the only thing we need to do, the last working, would then be to calculate tax saved on capital allowance. So I will say tax saved on capital allowance. Okay. Let's go to the question. Where do you have information on tax? So according to the question, initial outlay is 86 million naira. Initial outlay is 86 million naira. Then you are now told that the machinery is to be depreciated on a straight line basis. That is, capital allowance on a straight line basis over the next 4 years. And that's an expected salvage value. So examiner has already given us capital allowance to be 21 million. How did they arrive at the 21 million? So the 21 million naira is 86 million minus 2 million naira. That's 84 million. Divided by 4 years. That will give you 21 million naira. So that's how they arrive at the 21 million naira given to us in the question as tax allowable depreciation. Okay. So for me to now get my tax saved on capital allowance, if capital allowance given in the question is 21 million naira, that's what the examiner give it to me per year, 21 million naira per year. Therefore, tax saved on capital allowance would then be equal to capital allowance multiplied by the company tax rates. Company tax rates. So here it will be 21 million multiplied by, what's the company tax rates according to the question? Tax rate is 35%. So multiply by 35%. What do you have here? So 21 multiplied by 0.35 equal to 7,350,000 per year. So that's the tax saved on capital allowance. So these are all the necessary workings. I can then go ahead and begin to post. Let's go and post. So we're almost done. We're almost done. So I would then say, I want to, examiner say we should calculate capital allowance. Because you have so many multiple variables that you have done working for, it's better for you to first of all do net cash flow, calculate your net cash flow. I will then come here, I will say calculating net cash flow. Okay, figures are in million. Year 1, year 0, 1, 2, 3, 4, then workings. So the first item is your sales based on the format. And our sales based on the calculation we have done, working number 10. Sales for the first year is 132. 132, 202, 218. 132, 132, 202, 218. Then year 4. Year 4 is you have left everything for me. No problem. Year 4 is 236. 236. Here is 236. This is working number 10. Then after sales, I have labor cost. Labor cost is the first workings that we did. 35, 55, 61, 67. 35, 55, 65. Is this 67?
61, 67.
61, 67. 61, 67. Then after labor costs, the next working that we did under variable cost is material Z. So for material Z, we have 10, 16, 17, 19. Material Z. So 10, 16, 17, 19, is it?
17, 19.
17, 19. Working number 2. Then after that, we have component P. So for component P, component P, 17, 26, 29, 31. 17, 26, 26, 29, 31. That's working number 3. Then we have component Q. Under component Q, for component Q, 8, 12, 13, 14. 8, 12, 13, 14. 8, 12, 13, 14. That's working number 4. After component Q, we have other variable costs. Other variable costs, which is 344. Okay. Other variable costs. Three, four, four, four. Working number 5. Okay. Then after that, after other variable costs, we also have selling expenses. Other variable costs, we have selling expenses, 17, 17, 18, 19. Selling expenses, 17, 17, is it 17, 17, 18, I think. Then 19. Okay, number 6. Okay. Next item. 70, so yeah, 70, 70, 18. Then we have other overhead, 5566. Other overhead, 5566. Adibi, you are calling the numbers for me, could have been faster. But you left me. No problem. Selling expenses, other overhead. What did I even say? It's other overhead.
5 5566.
5566. Then we also have, after other overheads, we also have opportunity cost. Opportunity cost on rents, 12, 13, 13, 14. 12, 13, 13, 14. Opportunity cost. Rents, 12, 13, 13, 14. Working number 8. After that, we also have additional labor cost. Additional labor cost, 7788. Additional labor cost is 7788. Seven, 8, 8. Working number 9. So I think that's all. Working number 10 is selling price. We have accounted for that. 11 is a tax saved on capital allowance. So I need to determine profits. So I will then carry my calculator to say 132 minus 45 minus 28 minus that's 22, 30, 34, 41 minus 41. That's 18. Please confirm the number. 18.
Year
Next
4,
to
54.
year 4 is 64.
No, 54, 54.
54. Okay.
Year 2, 52.
54, 52. Please, this one is 7, oh, not 2. Okay. So 218.
Year 3, 49.
49. All right then. Thank you. So the next item will then be to pay tax. The company tax rate is 35%. Therefore, what's 35% on 18? 18 multiplied by 0.35. That will give me 6. Tax is paid in the current year. So 6, then 52 multiplied by 0.35 equal 18.
Sorry, sir. Please change the year 2 to 47. You know, I thought it was 2, but you said it's 7.
Okay.
So 47.
47
Yes, sir.
multiplied by 0.35. That's 16. Then 49 multiplied by 0.35 equals 17. The last one, 54 multiplied by 0.35 equal to 19. After tax, we need to claim capital allowance. Tax saved. Capital allowance for each year is 7.35. So this is 7, 7, 7, 7. Working number 11. Then we have salvage value. Salvage value is the same thing as scrap value, which is 2 million in the final year. Then we have initial outlay. Initial outlay is 86 million. Examiner told us there is no working capital. Therefore, here is 86. This is the net cash flow. 86. 18 minus 6 will give us a 12. 47. 47 minus 16, then plus 7. That's 38. 49. Now this one will be 59. Okay, no, that will be, what's wrong with you? $49 minus 10, that's 39. Then, of course, this one too will be 44. Please confirm the number. After net cash flow. So this is what I want to, this is what I need.
Year 1 is 19 and not 12.
Oh, sorry. Yes, error of mind. Supposed to be 19. True. Thank you. So this is the net cash flow. So with this net cash flow, I can calculate anything. Examiner is now asking me to calculate internal rate of return. I would then say calculating internal rate of return. I don't need to waste time. I will create a column for year. I will have cash flow, discount factor. I don't know. Then I will have the present value. Okay. Year 0, year 1, year 2. Wow. Okay. Let me manage it. Let me manage it. That space will not be sufficient. Okay. So I would then say cash flow. Discount factor. Then present value. Year 0, year 1, year 2, year 3, year 4. Okay. Initial outlay, my net cash flow is 86 in the first year, in the year 0. In the first year is 19, 38, 39. 19, 38, 39, then 44. Okay. So, oh, I'm supposed to leave a space there. Okay. Let's say this is year 0, 86. So let's assume 15%. When you add up your present, your cash inflow, 19 plus 38, that's about 57. 57 plus another 83, that's about 140 something. So almost double the initial outlay. So if you use 10%, if you assume 10%, you are going to have a huge NPV. So let's start from 15%. I would then say at 15%. So somebody should give to me a discount factor for year 1, 15%. Yes. Discount factor.
Year 2, 0.756.
Year 2, 0.756. Year 1 is what?
0.870.
870.
870.
Okay.
Year 3, 0.658.
658. And then year 4?
Year 4,
0.572.
572. Okay. Thank you. So the next thing I need to do now is to multiply. So 86 multiplied by 1 will give me 86 million. Okay. 19 multiplied by 0.870. What do you have?
17.
17. Okay. Next one, 38 multiplied by that.
29.
29. 29, okay. 39 multiplied by 0.658.
27.
27.
26.
26. Add it up. What do you get?
No, year 3 is 26, not 27.
Okay. Then 44 multiplied by 0.572.
38.
38. Add it up. 38 plus 26 plus 29 plus 17 equal minus 86. What do you have?
24.
24. Positive or negative?
Positive.
Positive.
Sorry,
Okay.
sir. Year 4 is supposed to be 25 now.
25. Okay. So that's a diminishing return. Oh yeah. What's the final answer? That's 51. 51 plus 29, that's 80. 80 plus
11.
11, positive. Okay. So that's the NPV at 15%. So let's assume 20% to get a negative NPV. Let's assume 15% to get a negative NPV. So here will be 86. So somebody should give to me discount factor for year 1 at 20%. 0. What? Yes.
0.833.
0.833.
0.694.
694.
578. 579.
579. So let's multiply. 44 multiplied by 0.482. That's 21. Yeah, give it to me now. 39 multiplied by 0.579 equal to 23. Okay. 38 multiplied by 0.694 equal 26. Year 1, 19 multiplied by 0.833 equal to 16. Therefore, 16 plus 26, that's 44, plus another 44, that's 88. 16 plus, no, sorry, 16 plus 26 is 42.
So it's
42.
0.
86.
0.
So answer is equal to 86 minus 86 is 0. So this is good. So I don't need to stress myself. Since our NPV is equal to 0, that means our internal rate of return is 20%. Remember, internal rate of return is the rate that equates NPV to 0. So I would then say, since examiner is asking me to calculate internal rate of return associated with the project, show all workings to the nearest. So that's that. I can then say, since IRR is the rate that equates NPV of future cash flows to 0. Therefore, the project IRR, let me use this space. The project IRR is 20%. So there's no need for you to go and be using formula again. You've already gotten your IRR. So that's it. So that's it. In the B and then C part of the question, of course, you have to state all your assumptions. You have to state all your assumptions. So in the B part of the question, examiner is asking you what is asset beta and different from equity beta. Just explain, define what is asset beta, what is equity beta. We have done it previously. Then you are given numbers and you now have to calculate cost of equity and recommend whether the company should introduce the product. Again, in this case, just use the formula of capping. Risk-free rate plus beta multiplied by market return minus risk-free rate of return. So you get your answer, then you now use it to advise on the basis of capping. So when you are doing that, just negate the capping. That is all the disadvantages of capping, the limitation of cappings, which is embedded in the assumptions of cappings. Okay. Then number C. You are told that the government is worried the increase in corporation tax. Advise the director by how much tax rates would have to change before the project is not financially viable. Again, in this number C, examiner wants you to calculate sensitivity margin of tax liability. So, but in any case, for the B and C, for those of you that have the golden book, so you can check the solution from there. But in any case, I will send the solution to B and C to you. All right. So that will be all for tonight. By the grace of God, in our next class, we are going to do free cash flow. Then after that, I will introduce you to adjusted present value. Please let me know if you have any question for me. Any question? Okay. So I thank you guys for your patience and understanding. I really appreciate the fact that you waited behind to see the end of the question. I personally appreciate that. Thank you very much. Then by the grace of God, next week we are going to continue. We'll start free cash flow. Then after that, I will introduce you to adjusted present value. Good night to everyone.
Thank you, sir.
You're welcome.
Yes, good night.
Good night.
Right, sir.
Good night.